Lesson 6, Buy and Sell Zones. Before we get started, I'd like to point out a couple things. As you go through your workbook, you'll notice that in the bottom center of each slide, there is a number. That number is the number of that slide. That number corresponds with the number in this presentation. If by chance you lose your place, just find out what slide I am on and match it up with the slide in your workbook, and you should be caught up with where we're at. The other thing is, I'd like to point out this sign here. This sign will appear during this presentation. On that page, whenever you see this sign, there will be a trader's tip or some very important information that you need to know, perhaps memorize, that can play a big part in helping you trade in the markets. There are 16 lessons on trading the Forex that can help you. These lessons focus in on technical analysis. Not only are they applicable to the Forex, they're also applicable to many other financial markets. Successful traders will do what unsuccessful traders can't do and won't do. I cannot overemphasize this. Think about it for a second. What's the difference between you and a successful trader? You both have two legs, two arms, two eyes. You see, you hear, you think. The only difference, perhaps, is what one knows and can do that you can't do. I've found that mentorship, education is very important to the success of a trader. It makes the difference between a successful trader and an unsuccessful trader. Discipline of that information and knowledge participates in your success. The 21-day 3% rule, which basically says the human mind forgets 80% of the knowledge it acquires within 3 days. If you listen to this CD or this lesson and you forget about it, you don't review it, if you don't use it, you'll lose it. You'll lose 80% of the information within 3 days of what you're learning here. Over the next 18 days, it will continue the loss of information until it settles at retaining only 3% of the original acquired information. Our focus here at Market Traders and Forex Tips is to help you have 85 to 95% recall of what's going on in the market so that you have a fighting chance at being successful as a trader. By the end of this lesson, you should understand that the markets can only move up, down, or sideways. You'll be introduced to the technical side of dealing with a trend and a trend line break. You'll learn what the buy and sell zones are. You will learn how to find a trade in the buy zone or the sell zone and create a trading plan. You will learn to trade that plan and financially protect yourself in every trade. To help you in this lesson, I'd like to review Lesson 1, which is placing your orders. We use Japanese candlesticks. They're more user-friendly. Lesson 11 really focuses in on some great trading techniques with Japanese candlesticks. We look at a bid chart. That is the bid price. Most traders watch a bid chart. There is the bid and the ask. The ask is always a little higher depending on what product you're trading. In the currencies, the ask chart will it be anywhere from 3 to 10 pips higher than the bid chart. It will look identical to the bid chart, just be a tab higher. As a trader, you buy on the ask and you sell on the bid. This is very important information. Here's that sign. You buy on the ask, sell on the bid, which means if you jump in the market and you're buying, this is the bid price. You do not buy on the bid price, you buy on the ask price, which means if this is the bid price, 107.30, these are your pips, the ask price would be 107.35. Once you place an order, you're going to learn to have, when you place a buy, you're going to learn to have two sells, one for a protective loss stop, one for a limit profit to get out. Whenever you have a buy, your two sells will be on the bid, which means if the market rallies, predominantly when the candle hits it, that's when the market hits your price, because you sell on the bid. Conversely, when you enter the market selling, you are selling on the bid, which means that would be the price. If we entered the market right now, we would get 107.30. Every sell needs to have two buys. If you should have a buy for profit and a buy for potential loss. We buy on the ask, which means the ask price is 3 to 10 pips higher depending on the currency you're trading. If the market were to rally up here and your stop order is up here, then the ask price is going to hit it before the bid price will, which means if the bid price never hits your ask price, your buy stop, you still will be stopped out, because if the ask hits it, then your order will be filled and you will have been stopped out. So keep that in mind. A lot of traders have difficulty sometimes remembering that we sell on the bid and we buy on the ask. Types of orders. A market order, if you want to understand your orders real well, lesson 1 once again focuses in on the types of orders. The market order is whatever the market is. There's a bid and the ask. That's the market. A limit order is an order that is placed at a specified price that you will be filled at that price or better, and a stop order is an order that turns into a market order when touched. Once again, here's the market. That would be the bid price, 107.30. Any order placed above this price, 107.30, anything placed above that would be called a working order, an open order. When you buy above the market, that order is called a stop order. When you sell above the market, that order is called a limit order. So if you placed a buy at 109, it's above the market, that is a buy stop order. If you placed an order to sell at 109, that is called a sell limit order. Those are the rules. This is something you'll just have to memorize. It's really not that difficult. Usually you'll have it down. The second day you start playing around with your software. Any order that's placed below the market, any order placed below this price is called an open order, a working order. When you buy below the market, that's called a limit order. When you sell below the market, that's called a stop order. Those are the rules. Here's another rule. Every time you buy, you should have two sells. A sell for potential loss and a sell for profit. Even if you are canceling, replacing, and chasing the market, have a wish list price, if you will. Place an order way out there just in case the market really rallies overnight or whatever, depending on how long you're staying in. But have a specified, what I call a lotto wish list trade, just in case the market, something happens and the market spikes up there and fills you, if you're canceling or replacing, that you'd be satisfied with. Once again, if you entered the market here on a buy, your stop order goes at the last low or where support is. Have a wish list way up here, many pips away, just in case the market takes off. You should have a limit exit order for profit. Every buy needs two sells. Conversely, every sell needs two buys. Whenever you're shorting the market, you're wanting it to go down, you're bear, your position is short, you will have a buy for profit and a buy for loss. Let's look at this chart. You enter the sell zone, which we'll be discussing today. You sell here, your stop goes at the last high. Every sell needs two buys. Here is your buy stop, and here's your buy limit. Once again, you may want to put in what I call a wish list order, and for large amounts of profit. OCO. An OCO is an order where you enter the market and you place a limit order at a specified price for profit, a stop order for potential loss. You set those numbers, you set it and forget it. The market will either do one of three things when you come back. You'll still be in. That would be option number one. Option number two is that the market would have rallied and paid you off here. If it rallies and pays you off here, it will cancel the stop order. That's what an OCO means. One cancels the other. If it hits that first, it cancels the stop order. If it hits your stop order, that's the third scenario, you will lose, and it will cancel your limit profit order, so you don't have a working order in the market. Canceling and replacing. Great information in lesson 16 and in lesson 3 on canceling and replacing. Remember, only cancel and replace to the new last low after the market has made a new high. Let's look at this. We enter here, market rallies, we lock in profit. As the market rallies and retraces a little bit and bounces, makes a new high, we'll move our stop order from here, this low, to now this low. Market makes a new high, retraces back, bounces. As the market is rallying here, taking out the old high, then we cancel and replace our stop from these lows to these lows. Market retraces back, bounces, U-turns, takes out the previous high. We cancel, replace to the new low. Cancel and replacing is not a greedy way to trade, it is an educated way to trade. The exact opposite takes place when you cancel and replace in a dipping or reacting bearish market. Only cancel and replace to the new last high after the market has made a new low. Let's just say your stop order is here, market dips down, it finally stops, creates a low, retraces a little bit, U-turns. Now at this time right here is when you are going to want to cancel and replace to the new last high or level of resistance. So that is very critical here. Bulls want the market to go up. Bulls buy low and sell high. They buy low and sell high. Here's an indicator trading, which is lesson number 4. Plays a big part in helping traders find comfort in their numbers. Indicators can give off buy and sell signals. Be that as it may, bulls want to buy low and sell high. They enter the market buying first, selling second. These 3 moves equated to 290 pips in profit. 1 lot is 2,900. 10 lots would be 29,000. Currency trading can be very profitable. Bears, they want to sell high first and then buy low later. When you sell first and buy second, you short the market. Even if you sell first and buy second, you still buy low and sell high. Look at how we sell first and buy second, but we still bought low. We bought it at 104 and sold it at 107. So the greatest part about currency trading is whether the market is going up, you can make money, and if it's coming down, you can make money. If you have any difficulty in learning to short the market, please give our company a call. We'll walk you through what it means to short the market. Technical traders learn to read charts. That's what this lesson is all about. Technical traders read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives the trader a high probability of knowing where the market is going. We don't make any money from past movement unless we are already in the market. When it's time to trade, we have to somewhat predict the future. We have to predict what the market's going to do. Technical analysis teaches us that the market will have a high probability of moving in a direction. That's the value of learning technical analysis. Because a chart is a chart is a chart, once you learn technical analysis, it'll play a big part in teaching you how to control all your finances, where you can pull up a trading chart. You can pull up trading charts on stocks, options, commodities, currencies. It doesn't matter what the financial product is. A quick review on support and resistance will also be very helpful for this lesson. We are working off of Japanese candlesticks. Remember, highs are 2 candles to the left that are lower than either the body or the wick of a candle, and 2 candles to the right that are lower. That constitutes a high. Here's that important information again. Remember, not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently being traded. Lows, 2 candles to the left and 2 candles to the right that are higher than the wick low or the body of the candle low becomes a low. There's that important sign again. Not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Lesson 2 really focuses in on support and resistance. It's a very good lesson. But remember, whenever you turn on a chart, go find all your levels of resistance. Remember, you are stepping up a ladder on all your levels of resistance, and you are stepping down a ladder or steps on your levels of support. Go find all your levels of support and resistance before you trade. Do not over or underestimate the financial game here between the bulls and bears. Bulls are trying to make new highs and take out old levels of resistance. Bears are trying to make new lows and take out old levels of support. Another lesson, lesson 5, trends and trend lines, will be helpful for understanding the buy and sell zone, uptrends. All trends move within a swing move. Remember, the upswing starts at a low and goes to a high, retraces back. An uptrend is when the market is swinging, making higher highs and higher lows. This is an uptrend. Uptrend is making higher highs. This high is higher than that high, and this high is higher than that high, and higher lows.